Ethereum has gone from $1,800 down to $1,400 in the last 7 days. And we've shorted this market, now locking in over 250% risk reward. And today I'm going to show you exactly how we did it in the R15 Crypto Gym. Now, you can also learn the 4 secrets on how to quantum leap your financial freedom to the next level by taking the free crypto trading masterclass, which actually breaks down a lot of things we're going to cover today. So let's now dive in to part of my crypto gym. It's the Telegram group that we have, and we run daily workouts. And when there's a high probability setup, we dive into it. So this over here was the Ethereum setup. And I just want to cover it in detail because it's one thing forecasting something or doing a technical analysis. It's another thing trading it and making money from the analysis. So what we did here was very logical and mechanical. First, we wanted to identify the trend. And the weekly momentum and the daily momentum were both pretty much pointing down. That just tells us that the probability is that the price is going to move sideways to down, and we're identifying this top over here. We had a pattern position called ABC. That's referring to this. It's the most common type of correction because remember, the markets are driven by fear and greed, human psychology, and we're always looking for patterns of 1, 2, 3, 4, 5, and ABCs. And this is when we're looking to short the market, and that's what's occurred over here with Ethereum. And then we're looking at price, we're looking at time, and then we're looking at short trade opportunities. So what we're going to do next, I'm just going to show you the next slide that I put into the R15 Crypto Gym. Short video that I want to play for you. And I tend to do short, I call them workouts, like a financial health workout. And we're just going to do the high level analysis in Ethereum. I'm playing at the speed of 1.5, but you'll get a gist of what type of technical analysis you should be doing to anticipate the move and then how to trade that move in advance.
Hey, Crypto Rebels. In today's workout, we're looking for a short potential trade with Ethereum. Remember, what we're doing here is high probability trading, getting the edge in our favor and then trading that edge. So the weekly momentum is bearish and the daily momentum is overbought. That just basically indicates that the overall trend is down. So we want to trade with the trend. So we're looking for only short trade setups. Then we're looking at pattern position. There's a potential A, B, C correction happening, and we're looking to trade at this wave C. Now, this wave B, what we really want to identify is the end of a wave B, which is the beginning of a wave C. And there's enough big movement over here to make some really significant profits if we get a tight entry. So we've got a nice clean pattern, A, B, C pattern. So this qualifies. So we've got double time frame momentum and we've got pattern. Then we want Fibonacci price. So this price movement has retraced back up to the 50% level. It's the 100% alternate price projection. So that qualifies for momentum, pattern, price. Now we are beyond the extreme of the typical correction time. This is normally the typical extreme, and we've done 100% alternate time projection. You now have access, by the way, to all of this training in your crypto gym.
So by the way, we're covering a lot of high level stuff. This is not beginner level stuff, but everything in life is difficult before it's easy. And it's one of the reasons I've created the R15 Crypto Gym. But even before that is the 4 Secrets Crypto Trading Masterclass, which you can now take. So if you find this is frying your brain a bit, I would actually recommend you take the masterclass and come back to this because it'll make a lot more sense because I covered this in a lot more layman's terms, and this will make just much more sense overall.
Included in your membership. So now we've got pattern, price, time, and momentum. So we've got 4 things indicating that the market is likely to do the next wave C. And there's never any guarantee, so we need to have tight risk management every single day of the week.
All right, so now we've got the setup in play, right? It's saying, look, market is looking like it's doing a textbook momentum, pattern, price, and time. This is looking like a nice wave B. And now we just want to short it in a nice logical manner. And so now we're going to move on to the next post that I did in the Crypto Gym, which is an image. And what we're saying here in this image is the setup. This is where we place the order. We're saying we've got a dual daily bear momentum. So momentum indicators basically measure the rate of change, right? And markets tend to move in these rhythms and cycles. And it's basically these blue and the red lines. And both look back periods is basically saying it's like a fast look back period and a slow look back period. What it means in English is the probability states. If we were at a casino, the probability states we're probably going to get sideways to down over the next 3, 4, 5, 6, 7 days. So we're looking at opportunities to short the market. Really, really important. But then we need a logical, mechanical way of taking advantage of this. So we've got the pattern price and time position in play. And the trade entry is go short on a 1 bar low. In other words, bet that the market's going to go down if the price goes below the previous 1-day low. Our stop loss is above here, and we're risking 2% to find out if we're right. We're also using something called the 14-day ADR. ADR stands for average daily range. It's basically taking the last 14 days of data of Ethereum, taking the average of the high and the low, we're putting that price onto the chart, which is this yellow line over here, and saying if the price hits this point over here, we're simply going to take our stop loss and move it to entry. In other words, making our trade risk-free. It's one of the best places to be, because now if the trade just goes in our direction and then moves against us, we lose zero. We either make a small profit, we break even, or we might take a small loss, right? It'll be one of those three scenarios. So this is what you call tight risk management. You probably are aware that I'm the award-winning author of the Extraordinary Venture Capital Opportunity, How to Invest Like a Pro. In this, every chapter I start with a quote. In chapter number 2, I do a quote from Warren Buffett, and he says, rule number 1 is never lose money, and rule number 2 is never forget rule number 1. The 14-day ADR, the 14 ADR, is a mechanical way of applying that particular rule. So now let's just go to the next post that I did. This is a short video. And again, I want to play this through for you because we did this ahead of time. So the data at this point hasn't unfolded. We do not know what's going to happen. We just know what's likely to happen. In other words, we're stacking the odds in our favor.
Hey, Crypto Rebels. Today we're going to dive into Solana because it's doing some interesting patterns. Now, there's actually a couple of different wave counts that we could actually identify.
The next Ethereum. It was an image. So we got triggered into the trade. So the next day we got triggered into the trade. We had a nice down bar, triggered into the trade. Actually, we got triggered the day before, but then the market moved really into our direction, hit the 14-day ADR. So we move our stop loss to entry, and now we're risk-free, right? The momentum is still pointing down, and we still anticipate good movement to the downside, but we have to apply something called doublethink. Doublethink is when you could get a correction and you could get the outcome you're looking for, but we have to plan and prepare for both at the same time. So it's a bit of a paradox. It's one of the reasons why trading can be difficult for most, because it's an unusual type of thinking that you have to do. This next one is a short video.
Hey, Crypto Rebels, Ethereum emergency update. The trend looks like it's coming towards an end. We've been watching this really, really closely, trading it short. We've had this nice wave 1, 2, 3, 4, 5, textbook style, anticipating a wave A, a wave B, again, textbook style, and then this final wave C. And we're going to pay special attention to this part over here on a lower degree time frame to see if it's breaking down to a clear 5-wave structure, which will give us a big clue on when we should anticipate the trend to end. We also want to pay attention to the daily momentum. It's becoming oversold. It'll probably become fully oversold tomorrow and possibly even bullish. That just tells us that we're close to the end of our wave C, and how it unfold, we don't know, but we want to give the market enough space to unfold to the downside to maximize our profits on the short trade, but also keep it tight enough in a logical mechanical position, which basically is what the market should not do.
Quick caveat, this video that I create in the R15 Crypto Gym, my Crypto Rebels, my students have access to all my training. So we've got Elliott Wave training, Fibonacci price, Fibonacci time, entry to exit training, and everything else, and all of that is available in the R15 Crypto Gym. And so everything is difficult before it's easy. So I'm talking at a pace, but because people in my community would have had training. So this is an internal dialogue that I'm sharing with you today externally. But in the 4 Secrets Crypto Trading Masterclass, I break this down at a high level that will take your trading to the next level. So I highly encourage you, check it out. It's in the description link below. It will blow your mind how the markets really operate in terms of fear and greed, the psychology of movements. So now we're going to drop down to an hourly chart to break down the wave structure, to really get very precise on managing our trade based on logic and non-emotional thinking. In other words, we're running a business. It's the business of trading.
So now I'm on an hourly chart, looking at the same information again. 1, 2, 3, 4, 5, a wave A, B, and we're going to pay attention to this part here, right? This big down bar over here. So just pay special attention. So what we've just simply done is taken the retracement, measure the full range of the price movement. We got the 50%, 62%, and the 78.6%. These are the 3 most common ABC end of corrections. We've got some time ratios, and we've got some more narrow corrections in terms of the price ratios with the external retracements. And then we're going to zoom in over here and pay special attention. So let me just zoom in. So we can really look at this in logical, mechanical detail. And what we see, if I just make it a bit clearer here, what I'm seeing is it looks like some type of 5-wave structure, which is breaking down to an initial move down, an ABC up, that's a wave 1, 2. We've had this impulsive move down. Now, at this stage, we wouldn't have known that this leg was going to occur. So this is where we're tying our stop loss for unit 1, and we took some good profits around this region over here for unit 1. And
so what I'm talking about there is something called the doublethink, right? So, and this is important because I found most people just want to be right all the time. Obviously, we want to be right. We want to make money. We want every trade to go our way, but that's just not realistic. So what we're doing over here is saying when we get a first 3-wave move down like this, we don't know if this is a wave A, B, C, and some type of correction, or if it's actually a wave 1, a wave 2, and at the beginning of a wave 3. We don't know. So what we have to do is, this is the double thing. This is the paradox. half of our thinking, the initial half of our position, the way I trade, is we're going to assume is actually just the wave C, right? So we want to take some profits over here and assume that the market's going to do this. And then the other half of the position, we want to assume it's a wave 3 and that the market's going to do this, right? And then you want to do both. And then there'll be times where it's a wave C and there'll be times where it's a wave 3, right? But we have to plan and prepare for both. And that's why I always use 2 units. Unit 1 is to be conservative, capital preservation, lock in some profits, become break even, and so on and so forth. And unit 2 is to assume the trend's going to unfold. It's a very difficult skill to really, really master. Golfers do it all the time. So golfers, I don't play golf, but there's a great book called Bounce, and he talks about the talent myth. We talk about golfers having to have double think. So when they play their shot, they have to visualize that they're going to get the shot in, but they also have to plan and prepare that they may miss. So if they miss, the ball doesn't go too far away from the hole. And it's the same kind of thinking over here. We got to plan and prepare that we're going to get the trend, but we have no control over the trend. So we have to plan that it might only be a correction. And that's just the nature and the business of trading, and it's just high-level risk management.
We moved our stop loss to break even on the 14-day ADR. We had this nice ABC, which looks like a classic wave 4 that doesn't overlap into the wave 1. And now we're looking at this last leg of the movement. And when we see a nice 5-wave structure, a 1, 2, 3, 4, 5, we want to be on high alert that we might be coming towards the end of a trend. We want to really lock in our profits. So what we've done now is moved our stop loss from break even for unit 2 to the overlap of this part of the market. Now, what do I mean by this part of the market? So let's zoom in a bit more. Again, we're just keeping it really logical. We want to ask ourselves the question, what should the market not do if it is coming towards a 5-wave end of a correction? Well,
now, in my R15 Crypto Gym, my Elliott Wave course is Foundation, Intermediate, and Advanced. And what we're going to talk about now is Elliott Wave theory. Elliott Wave, Ralph Nelson Elliott in the 1800s, 1900s, genius of his time, figured out that the markets are driven by fear and greed. And what we're talking about is fear and greed. And when the market's playing out, we're really reading how the crowd psychology is feeling right now and what will void the wave count and what will confirm the wave count. And we can use that high-level psychological, practical information to apply our stop losses. And that's what I'm talking about here. So what I'm going to talk about here, I say it quite fast, hence I'm breaking it down, is that this looks like a potential 1, 2, 3, 4, 5. And if this is a wave 1 and a wave 2, on a micro degree, it's like a smaller degree wave count, the market should not go back into this range until the trend is complete. So then we can say, okay, if the market should not go into this range, well, then it makes sense to put our stop loss here. We shouldn't have it any higher. We shouldn't have it all the way up here. We can have it down here. And that's what we're looking for, is logical points of what the market should not do if the trend is to continue. And if it does that, we say, right, we want to be out of the market, lock in our profits, right? Then we go on to find another trade.
Well, first of all, this over here in itself, you can probably spot it yourself as well to a certain degree. This part of the market looks like a wave 1, a wave 2. This actually looks like a wave 3, a wave 4. We're probably going to get a final leg down of some sort. We don't know exactly how it's going to unfold. And the good thing is we don't need to know how it's going to unfold. The key thing is that we just have logical, mechanical decision-making skills. So now we've got a stop loss at the extreme of this wave over here, which is over here. So we locked in some really good profits for unit 2. But we don't need to tighten our stop loss too much because this looks like a wave 1, a wave 2. It looks like a wave 3. So we're going to anticipate some type of wave 4. And if we do get a move down like this, so like a 1, 2, 3, 4, and then we get the final move here, we can tighten our stop loss over here, and then we're in a logical place of trailing our stop loss because the market might just move down to the next level. So the last thing I want to cover with.
And that's exactly what's happened. That's exactly what's happened. So most amateurs, what they'll do is they'll get too excited. Like they'll be taking profits over here because the market's moved. They'll be taking profits over here at a fixed point. But that's like telling the market that you know what's going to happen. And that's amateur thinking. The thing you really want to know is that you don't know. And that's a good thing. Why? Because it means the market can just tank. And if you're shorting the market, we want to be in the position if it tanks. If it goes from 1,400 to 1,100 and we're taking profits at 1,400 just because we felt like we should, then we're losing out because 10, 20, 30% of the time, it would just overextend. We saw that with Lunar Classic. It hit certain ratios, but then it overextended, and then it overextended some more. And we want to be in those positions as it overextends. So what's actually happened with Ethereum is it did do a move up and a move down. So then we did move our stop loss from here to over here. And then the market's moved down, it moved up again, it moved down. Well, guess what? We just moved our stop loss to over here. Now we're waiting for the market to stop us out, right? And that's a great thing. That's a great thing to lock in profits. But guess what happened? Is on another swing high and swing low. So I move my stop loss over here. So now we're just trailing it one step at a time, until we get stopped out. But it might just have another big down bar. I don't have control over it. You don't have control over it. So why are we going to make a guess of information that we just don't know? The probability states we're coming towards the end of a trend. So we're trailing quite tight to the market, but we want to give it enough space. So if it does overextend to the downside, to the next Fibonacci price level, we make profit from that. Right, I think that was the last post in the Crypto Gym regarding Ethereum. It was brilliant. All right, so now what we're going to do is going to finish up on some numbers, right? So at the beginning, I said 250% plus risk reward locked in. So we're going to cover some of these numbers, right? Because I got a degree in mathematics. I love statistics. I used to be a teacher of mathematics. I qualified to teach up to A level in the UK. I used to teach in South London back in, I think it was 2005, 2006, 2007, or 2006. 2006 was my time then. And I applied that math over here. So what we're going to look at over here with Ethereum is we've got 2 units. We're going to go into detail. These are the current stop losses. One of the positions is closed, which we spoke about. One is still open. So we're still trailing that stop loss. We've made a total of 5.04% of a whole account size, which is actually not that. It's actually 250%. 250% risk reward. And we're going to cover that in detail right now. And by the way, I highly encourage you, check out the 4 secrets that will literally quantum leap your financial freedom to the next level in my free crypto trading masterclass. Because if you like what you're seeing, there's a method to the madness. Arthur C. Clarke said it nicely. He said, any advanced science or technology that's advanced enough is indistinguishable from magic. And some people think I got a crystal ball performing some type of, magic, and I got a gift from the gods. Hey, look, it's the closest thing, because we're talking about crowd psychology, humans. We're talking about the unconscious. We're talking about so many things over here, but we're simplifying the heck out of it with the 4 secrets. And that's what I cover in this masterclass. So the last thing we're going to cover is the numbers. Right, so I've just got the numbers over here, high level. And this is what we do in the Crypto Gym. Part of the Crypto Gym is we actually trade for you. That's one of the things that we do as part of the Crypto Gym. It's not mandatory, but it's optional. So we entered the trade on the 12th. It's Ethereum. We risked 2% in 2 units. This was the entry and the stop losses, the initial. This here was the trailing stop loss. So as we're triggered into the trade, we're training it in a logical, mechanical way. This is to assume we're wrong, unit 1. We got stopped out for a nice 144% risk reward. In other words, we risked 1% and we made 1.44%. It's pretty decent. Nothing to write home about, but it protects us. It's the insurance policy. And then unit 2, we're still open in unit 2. Hasn't been stopped out. This is the current stop loss, meaning we've locked in the profit. And if the market moves above this point over here, we will lock in 360% risk reward. In other words, second unit, we risk 1%, and it's currently running at a 3.6%, which is 360%. So the total risk reward, we risked 2% to make 5.04%. Could become higher because we don't know yet, but it's a total of 250%. So what does that mean in English? I know I'm a mathematician, right? And some people love math and numbers and other people don't. So what it means is this. If you got a $10,000 account and we're risking 2%, well, you're risking $200 to find out if you're right. And if you make a 2.5x, 2.52x, it means total you made $504 profit. Right? That's good money. That's 5%. If you did that compounding, even 1 month, every single month, 5% a month, considering what the banks pay you in a year, that is extraordinary. But we're trading a wave C over here. A wave C is a small wave, right? And we're now getting ready to get the impulse wave of the wave 3. And wave 3s tend to be just a massive move. And we're anticipating that Ethereum is going to go over $3,000. Over $3,000. So this was like a $400 move. What we're talking about, $1,700 to $1,400, $300 move, right? Next, we're anticipating a $2,000 to $3,000 move with compounding as well. And that's the whole name of the game when it comes to trading. So I think that's all I want to cover with you today. I think that's everything. The last thing I just want to make sure you're aware of is take the R15 Crypto Masterclass. It's free. I've put my best thinking here to make it as simple as possible for you to understand. In fact, we'll finish on one actual last thing. It's my quote from my book. You can actually download this. You see it on this webpage as well. You can download my book. It's chapter think it's chapter, what do we go for? We have chapter 3, right? So we're going to finish with Confucius today. And he says the following: it does not matter how slowly you go, as long as you do not stop. So everything in life is difficult before it's easy. So when you take what we covered today was high level, right? We're covering multiple degrees of wave counts. We're covering Fibonacci ratios, Fibonacci time, and momentum on different time frames and everything else. So it's a lot of information. But you can take the masterclass and just learn one thing at a time. If you like it, you'll get an opportunity to join the R15 Crypto Gym, where you'll get access to all my courses. I made it so affordable; it's gonna blow you away. But the masterclass will kind of give you a feel for what I'm about, what we're about, and what we're trying to already accomplish over here. So if you like today's content, like, subscribe, hit the bell notification. I will see you in the masterclass.